Okay, folks, it's the last day of the quarter, first quarter 2023, and I want to review my portfolio. As many of you know, I use buckets. I have 3 buckets, okay? Bucket 1, the target is 4 years of expenses, completely out of the market, in things with no risk, like T-bills, very low risk, CDs, I-bonds, things like that, savings account, completely out of the market, 4 years, bucket 1. Bucket 2 are funds that I need, years 5, 6, 7, and 8. Those can be in balanced funds, income funds, dividend type funds, even bond funds, just with much lower expectation of return than full equities, but less volatility comes along with that. And then bucket 3, 100% equity, money that I need year 8, year 9 and beyond. So each bucket has a purpose, okay? So once a quarter, I look at the ability of that bucket to do its purpose, okay? Most quarters, I make no moves. This quarter, I made a move. So let's check out, see what that is and why. Okay, so here's the update. Bucket 1, I actually have 3 years of expenses out of the market. My target's 4, remember. And my target when I originally set this up in 2019 was to get a 0% return there. Remember what conservative investments were getting, like bonds and CDs back then. And I didn't calculate what I'm actually getting there. I have some money in CDs. One of them's paying 4.61. I bought some I-bonds that are, increased with inflation. Those were paying over 9% when I first got those. So it's just a little confusing what I've got, but it's bigger than 0. But this is not at 4 years, and that's because the market is down. The stock market is down. Most of my investments are down, so I don't top off buckets during down markets. Okay, that's kind of the rule. So this is to help me get through 4 years, is to get through most of a typical bear market drop. 4 years gets me through that. So I'm just riding the storm out, right on plan here. Bucket number 2, I've actually increased that to 6 years. And that's my target was 4 years. And my target was to get a 4% return out of these type of investments. Year to date, it's up 2. 1 year, it's down 4. But since inception, it's been up 4. I have, 50% of it is just in a pure balanced fund. That's a managed fund. 25% is in a dividend balanced fund. So it's got like a 60-40 portfolio, stocks to bonds. Heavily dividends are in the equities. And then I got a pure equity play here of 25%. So you may be wondering, okay, during this down market, how did that go up? How did that go up? Well, folks, it was due to my lower spending rate. Okay, so if you remember a couple videos ago, I said, hey, I'm spending 25% less than what my plan was. So I set this up with 4 years. So I haven't made any adjustments. I just let it go with my lower spending rate. And then also, I've been making more income. I've been making income from this YouTube channel, a little consulting and mentoring that I do, some individual coaching on retirement that I do. And that has allowed this bucket 2 to grow for 3 more years than what I expected. So it's growing for 3 more years, which, when I retired 4 years ago, I should have already been in the bucket 2 already. 4 years ago, that should have wiped out bucket 1. I should have been into bucket 2. It should have moved bucket 2 should have turned into bucket 1, but it didn't for these 2 reasons: lower spending, and I'm making income. Okay. So, and then bucket 3, I'm still down 11% for the last 12 months, but I retired in 2019. So 4 years ago, right at 4 years, and I'm returning 7%, the compounded annual growth rate. So I'm doing well there. Not if you look at last year, but if you look in aggregate, it's fine. My target was to be pessimistic for you new retirement fans. 5% pessimistic, 7% average, 9% optimistic. So in this down market, I'm right at the average return. I'm doing great. Hey, I have a buddy that was really stressing that the market was down and what are you doing? What are you doing? And what I told him to do is, instead of looking at the 12-month chart, to look at the 5-year chart, and you're happier. So, just don't look just at the last year. Look at the time since inception of of your retirement, and look at your compounded annual growth rate. I feel pretty good about where I am with bucket 3. Bucket 2, I'm a little heavy, and here are the 2 reasons. Bucket 1, I'm a little light. So what moves did I decide to make? So here you go. Bucket 1, still got less than 3 years. This is just a repeat. I do have some CDs and bonds in there, okay? But bucket 2 is the big change, which impacts bucket 1 here. JP Morgan Chase has a CD paying 5.1%, 12 months. Okay. T-bills that I looked at, 4.65. The advantage of those is no state and local tax. Indiana, the tax is around 4%. So that has a 0.2% advantage. So this would, to be equivalent, this would be 4.91, which is still better here. So what I decided to do was to sell my pure equity play, the fund that was in here. I sold it, and bought this JP Morgan Chase 12-month CD. That has and then I'm actually transferring that in my funds to bucket 1. That's going to take bucket 1 to 5 years, and that takes bucket 2 down to 4 years. Okay, so when you look at my buckets now with that move, locking in the 5.1%, remember my goal, even in bucket 2, was 4, and my bucket 1 was 0. I locked in those gains. So my bucket 1s are 5 years, a little heavy, but not too bad in a recession, on the cusp of a recession, soft recession, hard recession, whatever people think. I'm staged pretty good, getting a lot more than 0% return with my CDs and I bonds that I'm gonna have, that I got here. And then bucket 2, I got 4 years and no change to bucket 3. So I'm feeling pretty good. A very common discussion I get into with coaching clients is you must break the lifelong habit, your entire career of saving. You're seeking the best returns, and you can, manage your way through any bear market. You just dollar cost average in, keep your head down, don't look at your balances, and keep going, okay? In retirement, that game changes. You don't simply chase returns. In retirement, you need some safety, you need some protection. I like quoting another YouTuber, Josh Scanlon. A lot of you folks watch him. He says, if you won the game, stop playing. I use the analogy, if you're up by 3 touchdowns using American football, in the fourth quarter with 5 minutes left in the game, you don't need to score anymore, okay? You don't need to score anymore. So you want to get the highest returns you can, but with the least amount of risk. So be careful chasing returns when you're in retirement. Yes, I took some growth off the table. I took a pure equity play that could go up 25% next year, in the next 12 months. Could go up, could go down, okay? I chose to lock in 5.1% because that's what bucket 1 is supposed to do. That's supposed to just protect me against the bear market. Bucket 2, I'm only looking for 4% return, to make all, my defense work against the drama of the market. And I locked in 5.1, okay? So be careful with, getting greedy. getting greedy and chasing the highest possible returns, because that comes with increased risk. Here is an example of an actual move I made where that's exactly what I did. I locked in my gains. I didn't take a loss on the equity fund. I actually have to pay some capital gains on it. So that's the, I guess, good news. I have to pay capital gains. But this is just part of my cadence, looking at my buckets. Are they doing what I want them to do? Are there better options to take risk off the table and protect my hopefully 30, 35, 40-year retirement? Okay, what do you guys think? Did I make a mistake? What would you have done? Does this make sense to you? Always let me know where you're from if you don't have anything better to say. I love hearing where you're from. And if you think I did something wrong, let me know that too in a kind and gentle way. Okay? This is Joe out.